Steve here. The morning ledger is officially open. Welcome to today's explainer. Look, the bulls pushed for yet another record close today, but if you actually think this market is just a one-way ticket straight up, man, you aren't paying attention. Today we're taking a hard-hitting look at the verified, on-the-ground reality. We're going to strip away the marketing, totally ignore the mainstream noise, and compare the real market data against that pretty little narrative being shoved into your feeds. All right, let's dive into this.
Now I want this quote right here to be your absolute mantra for the week. If you're buying the euphoria without checking the fine print, you're flying blind. We are heading into a trading week where the front pages and the trading algos are literally screaming peace. Everybody wants to believe the geopolitical dust is finally settling. But listen to me, there is a dangerous, glaring disconnect right now between those rosy, feel-good headlines and what the heavy hitters are actually doing with their capital. While retail is out there blindly buying the top, the smart money is moving quietly, methodically, right into the bunker.
Let's rip through the Monday closing tape, because these numbers tell the real story here. The S&P 500 finished at 7,412.84, punching right through to a new record close. Bitcoin, it's stalking uncharted air at 81,606 bucks. You see that and you immediately think, okay, it's risk on across the board. But hold up, look at the other side of the ledger. Brent crude settled at 103.45 on a volatile slide, and gold recovered to a massive 4,727.16. You've got this tech-fueled euphoria on one side and massive defensive safe haven hedging on the other. Folks, that right there, that is the definition of a fractured market.
Now just look at how wildly overextended this S&P chart truly is. The bulls staged a massive ambush right at the bell today. We saw the indices just rip higher as the algorithms blindly reacted to a labor report from last week and a geopolitical narrative that frankly is shifting by the hour. But do not let these green screens intoxicate you. Tech remains pretty much the only safe harbor for growth right now, and this price action, it's a facade. It's an intoxicating facade built purely on shifting sand.
I want you to pivot away from that retail euphoria for just a second, and let's look at the smart money out in Omaha. Greg Abel just released the first Q1 report of the post-Buffett era for Berkshire Hathaway. $397 billion. Yeah, you heard me. That is Berkshire's cash pile. It has hit an all-time staggering record. Just let that number sink in for a minute. That's enough cash to buy entire mega corporations outright. While the retail market is busy throwing a party for 7,400 on the S&P, the biggest players in the game are hoarding an absolute fortress of cash. So let's break down this Berkshire exit strategy. They have been a net seller of stocks for 14 consecutive quarters. Think about that. Abel isn't buying this tech-heavy squeeze. They are sitting on nearly $400 billion in dry powder, just waiting for the propaganda to fail and the real snap to happen. Look, if the Oracle's playbook involves hoarding cash at these levels, you absolutely shouldn't be sitting there fully leveraged. And the catalyst? It could be right around the corner. Tomorrow at 8:30 a.m., we get the Consumer Price Index. This is a massive red folder event, guys. If inflation stays sticky while productivity stalls out, well, the stagflation trap is officially set.
Now, let's see how this ties into the geopolitical side of things, because it is directly feeding the market's confusion right now. I need you to strip away those social media victory posts you're seeing everywhere and force yourself to look at the physical geography. This choke point right here, the Strait of Hormuz, this narrow strip of water dictates the entire global energy market. And the physical reality on the water is a far cry from what those optimistic headlines are trying to sell you.
Here's the actual geopolitical ledger as it stands today. That supposed peace deal, the so-called one-page memorandum, it's completely failing. Tehran has officially balked at it, outright demanding an end to the naval blockade and full sovereignty over the strait. And the White House's response was absolute. They called it totally unacceptable. So where exactly does that leave us? It leaves us with a hard ultimatum. We are officially back on a 48-hour clock, with a very real, looming threat to target Iran's domestic power grid. That, my friends, is the only card left to play.
So, the absolutely crucial takeaway here is this. Do not believe the open straight headlines. Independent trackers are showing near zero commercial movement through this transit path. Zero. Maritime insurance firms are looking at the risk profile and they are outright refusing to cover hulls. A diplomatic memo does not clear a literal minefield. The water is physically closed for business, plain and simple, until the guys writing the insurance policies say otherwise. Which brings us right over to Brent crude. Notice this violent gapping on the chart. Oil is sliding around that 103.45 mark, but it is reacting to every single piece of news, every rumor, and every tweet coming out of the Gulf. It's completely unstable. Honestly, it's acting like a barometer for the sheer panic and uncertainty happening behind closed doors. Trust me, if peace was actually secured and locked in, this chart wouldn't look like a heart monitor during a cardiac arrest.
Heading into the rest of the week, the market is basically split into two opposing battlefield scenarios. On the left side, you've got the bullish view, the Beijing dividend. This camp is betting that a scheduled visit to Beijing forces some kind of diplomatic breakthrough. If China steps in and leverages its influence to reopen the strait, well, the S&P easily locks in 7,500 and oil probably crashes right back down to the $80 handle. But on the right side, you have the ultimatum trap. This is the bearish, ugly reality. If this transit stall is just a middle finger to the deal and bombings actually resume tomorrow, man, $103 oil was an absolute gift. We're talking $150 Brent and a very violent test of the 50-day moving average on the S&P.
All right, so here's the playbook. I'm leaving you with some strict technical trading directives for the Tuesday open. Order number 1, ignore the noise. Watch the Aqua 20 simple moving average. The S&P is overextended, so if we gap down below 7,380 tomorrow morning, that relief rally is officially over and the trap is set. Second, trust the energy pits. If Brent stays about $100, it means the seasoned professionals aren't buying this peace story for a second. Oil traders almost always know the truth first. Finally, keep your eyes on the gold floor. Gold holding strong at 4,727 confirms the big players are still aggressively hedging for the absolute worst-case scenario.
I'll leave you with this final thought as you prep your screens for tomorrow. Small sizes, tight stops. The ledger doesn't wait for latecomers. Keep your safe haven positions tight. Do not let these flashing green screens trick you into flying blind into a stagflation trap, or worse, a geopolitical landmine. So I want you to really ask yourself before that bell rings tomorrow morning, are you actually trading the reality of the tape, or are you just buying the euphoria? Stay disciplined, watch your averages, and survive the morning bell. This is Steve. The ledger is closed.